On a cold Tuesday morning in April 2015, plainclothes police and FBI agents met at a McDonald's near Heathrow Airport. They were finalizing a plan to raid a beige, semi-detached house in a nearby residential suburb. The target was 36-year-old Navinder Singh Sarao. When the officers arrived at his door, they found him asleep in his childhood bedroom, surrounded by soccer trophies and a large stuffed tiger. Prosecutors alleged that Sarao had used a standard home computer to amass a $70 million fortune. More specifically, they claimed his activities helped trigger the 2010 flash crash, a chaotic event that saw the Dow Jones drop nearly 1,000 points in minutes. The arrest highlighted a bizarre disparity. A single man in a modest bedroom was accused of destabilizing a marketplace populated by the world's most powerful banks and asset managers. Understanding the mechanics of this crime requires looking past the suspect and into the digital architecture of the modern stock market. By the late 2000s, the traditional image of traders shouting in crowded pits had been replaced by a silent, anonymous network of matching engines. The market was now a collection of servers, processing thousands of orders every second. This shift toward automation gave rise to the algorithmic trader. Financial firms began relying on computer code to execute trades autonomously, prioritizing logic and speed over human discretion. While this was intended to make the markets more efficient, the transition to a machine-run system introduced a specific vulnerability that a skilled observer could anticipate. For over a century, futures trading relied on face-to-face interactions. Success depended on reading the room and physically asserting yourself in a crowd. Sarao entered the industry just as this physical world was ending. Operating from a small office above a supermarket, he viewed high-stakes trading with the same hyper-focus he applied to competitive video games. The core of his workspace was the central limit order book, often called the ladder. This interface displays the live queue of every buy and sell order waiting at different price levels. While most see a chaotic blur of data, Sarao possessed a high degree of pattern recognition. He could watch the numbers shift and intuitively sense when the market was about to move. By 2007, Sarao had reached a dominant position, frequently transacting with a speed and volume that rivaled massive corporate institutions. That same year, the environment began to change. Massive Wall Street firms began deploying high-frequency trading algorithms, or HFTs. These algorithms operate in millions of a second. They identify trades and jump ahead, capturing profits before a human can even click a mouse. Sarao found himself constantly outpaced. He became convinced the market was rigged, complaining to the exchange that these machines were specifically designed to pick off independent traders like him. The machines didn't have a better understanding of the economy. They simply held an insurmountable technological lead. For a point-and-click human trader, the game was becoming impossible to win. But as he studied their behavior, Sarao identified a flaw. Despite their speed, the algorithms were unthinking followers, programmed to react predictably to changes in the order book. He decided to retaliate using a tactic called spoofing. He would place a massive block of fake sell orders high up on the ladder. The algorithms would see the sudden supply, assume the market was about to crash, and immediately drop their prices to get out of the way. The moment the price fell, Sarao would cancel his fake orders and buy up the contracts at the deflated price. He was essentially herding the world's fastest machines into a trap of his own making. To maintain this pace, Sarao commissioned a software developer to modify his trading platform. The new code automated the deception, allowing his home PC to spoof the market as efficiently as a Wall Street server. By weaponizing the highly predictable reactivity of the algorithms, Sarao turned their primary advantage, their speed, into a liability. The custom software was incredibly effective. Sarao generated tens of millions of dollars in profit while continuing to live a frugal, isolated life in his parents' house. However, his strategy had a destabilizing effect. By constantly tricking the algorithms into sudden movements, he was injecting extreme artificial volatility into the trading ecosystem. 5 years later, investigators correlated his software's activity with the moments preceding the 2010 flash crash. They concluded that his massive fake orders contributed to the systemic breakdown that wiped $1 trillion from the market. Navinder's attempt to fight back against the automated firms he despised eventually made him the central figure in one of the most significant market investigations in history. The case of the Hound of Hounslow exposed a series of fundamental cracks in the modern financial architecture. Wall Street believed that removing human error through algorithmic trading would create a more stable market. Instead, they built a system that reacts so predictably it can be manipulated by anyone who understands its underlying logic. Today, the values of the world's largest corporations and the retirement funds of millions of people remain tied to this same automated infrastructure. The global exchange of value now functions as a network of algorithms, a digital environment that remains susceptible to a lone actor with the right code.